Your HR department sent you a benefits guide this year. Glossy, organized, professionally written. It explained your options clearly, walked you through enrollment deadlines, and made the whole system seem transparent and navigable. What it didn't tell you, what it was never going to tell you, is that several of the decisions embedded in that guide, if made the way most employees make them, will quietly transfer money out of your pocket and into a structure that benefits everyone in that system except you. Not through fraud, not through deception, through architecture, through defaults and framings and timing mechanisms designed by people who understood exactly what an uninformed employee would do when presented with each choice. That's the game, and the guide is part of it. Compensation is not what your offer letter says it is. That number, the one you negotiated, the one you told your friends, the one that felt like validation of everything you'd built to that point, is the beginning of a calculation, not the end of one. By the time your actual take-home wealth is determined, a series of decisions will have been made, most of them during moments of low information and high distraction, that can alter the real value of that number by 20, 30, sometimes 40% over a career. The decisions that do the most damage aren't the dramatic ones. They're not the ones you agonized over. They're the ones you made quickly during onboarding, when you had 17 other forms to fill out and someone was waiting for you to finish so they could move to the next new hire. They're the defaults you accepted because the default seemed fine. They're the options you didn't select because you didn't fully understand them and asking felt like admitting something you didn't want to admit in the first week of a new role. HR professionals are not your adversaries. Most of them are doing a job that serves legitimate organizational functions. But the system they administer was not designed with your financial optimization as its primary objective. It was designed with cost management, legal compliance, and administrative efficiency as its primary objectives. Those goals and yours sometimes align. When they don't, the system wins by default, literally, because the default is almost always the choice that serves the system. What follows is a map of where the defaults are set against you and what it actually costs to accept them without examination. The first trap is the one that does the most damage over the longest time frame, which is why it's also the one most employees think they've already handled correctly. Accepting the default contribution rate on your retirement plan. When you enrolled, there was a number already in the box. 3%, maybe 4%. It felt reasonable, you were contributing, you weren't ignoring retirement, you were being responsible. What you probably didn't examine carefully was where that number came from or what it was actually optimized for. That default was not set by running a calculation about what employees need to retire comfortably. It was set by modeling what contribution rate employees would accept without complaint during enrollment while minimizing the payroll cost impact that high participation rates create for plan administration. In some cases it was set even lower, just high enough to appear responsible, just low enough to cost the organization as little as possible in matching obligations. I sat with someone once who had been at a company for 11 years, contributing at the default rate the entire time, believing he was being matched to the maximum. He wasn't. His plan had a matching structure that capped at 6% of salary, and his default contribution was 4%. For 11 years, he left 2 percentage points of free compensation, his employer's money, sitting unclaimed on the table every single pay period. The compounded value of that gap, projected forward to retirement, was not a rounding error. It was the difference between a meaningful retirement cushion and a serious problem. The trap isn't the default contribution rate itself. The trap is that the default was presented as a recommendation when it was actually an administrative convenience. And the framing, pre-filled already in the box, requiring active effort to change, meant that most people accepted it as informed guidance rather than what it actually was. A starting point set by people with different interests than yours. Max your employer match first. Always. Before anything else. That match is the only guaranteed return in your entire financial life, and leaving any portion of it unclaimed is a decision with a price tag most people never calculate because they never look. The second trap operates through timing, and it's particularly dangerous for employees who are good at their jobs and expect to be promoted. Not understanding how vesting schedules interact with your actual compensation. Your offer letter stated a salary. It may have also stated equity, a signing bonus, or employer retirement contributions. What it almost certainly did not state clearly, because clarity here serves you, not the organization, is the precise mechanism by which those additional components become yours, and what you forfeit if you leave before specific dates. Vesting schedules are retention tools dressed as compensation. They work by making your total compensation real only in installments, contingent on your continued employment, structured around intervals that are calibrated to be just long enough to feel costly to leave before reaching, and just short enough to seem reasonable when you're evaluating an offer. The trap is making career decisions about when to leave, when to take another offer, when to negotiate, without knowing exactly where you are in the vesting cycle and what the true cost of moving is at any given moment. I've watched people leave roles 6 weeks before a cliff vesting date that would have transferred a significant equity grant into their name permanently. Not because they were careless, because nobody had explained that the difference between leaving in week 46 and week 52 of that particular year was worth more than their entire annual bonus. The organization certainly wasn't going to explain it. The exit interview was not going to include that calculation. The information existed in their plan documents, which they'd filed away during onboarding and never reopened. Your vesting schedule is not an HR administrative detail. It's a map of your actual compensation over time. Know it the way you know your salary. Because every career decision you make without it is being made with incomplete information about what you're actually earning. The third trap is the one most people feel smart for navigating, which is precisely what makes it effective. Choosing health insurance based on premium cost alone. Open enrollment arrives, you have options, and the most visible number on the comparison sheet is the monthly premium. The high deductible plan is cheaper month to month. The math seems obvious. You're healthy, you're young, you're not planning any major medical events. You take the lower premium, feel financially disciplined, and move on. What the comparison sheet typically does not foreground, because foregrounding it would require a level of consumer education that serves you and not the plan, is the total cost exposure under each scenario, and more importantly, the tax-advantaged vehicle that the high-deductible plan unlocks. A health savings account, paired with a qualifying high-deductible plan, is the only triple tax-advantaged account in the American financial system. Contributions go in pre-tax, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. After age 65, it functions as a second retirement account with no penalty on non-medical withdrawals. It's one of the most powerful wealth-building tools available to employed individuals, and it's sitting attached to the plan that looks less attractive on the premium line. Most employees never open an HSA at all. Of those who do, most use it as a spending account, depositing money and withdrawing it for current medical expenses, rather than as what it actually is at its most powerful: a long-term investment vehicle that happens to have a medical expense exemption. The employees who understand this fund the HSA to the maximum, invest the balance, pay current medical expenses out of pocket when possible, and let the account compound for decades. That's not a niche financial strategy. That's the intended use of the instrument. The intended use just happens to require a level of financial literacy that neither HR nor the insurance carrier has any structural incentive to provide. The fourth trap is invisible until the moment it isn't, which is usually a moment of genuine crisis. Underinsuring on employer life and disability coverage without examining what the employer-provided baseline actually covers. Most employers provide a base level of life insurance, often 1 times annual salary, and short-term disability coverage as standard benefits. Many employees look at that coverage, note that it exists, and conclude that they're covered. They are, for a very specific and usually inadequate definition of covered. 1 times annual salary in life insurance is not a financial plan for a family with dependents and a mortgage. It's an administrative baseline that satisfies a benefits checkbox. The gap between that number and what your specific situation actually requires is a gap your employer has no obligation to close, and very little incentive to help you calculate. Disability coverage is the more dangerous gap. Most employer-provided short-term disability replaces 60% of salary for a limited window. Long-term disability, the coverage that matters when someone is out for months or years rather than weeks, is often optional, often undersubscribed, and the employer's contribution to it is frequently structured to minimize their cost rather than adequately cover the employee's actual income replacement need. The trap is conflating the existence of coverage with the adequacy of coverage. They're entirely different questions. The first is answered by your benefits summary. The second requires you to actually run the numbers against your specific financial obligations, and most people don't because the benefits summary doesn't prompt them to, and asking HR for help with that calculation is asking the person administering the system to critique the system. Examine your actual coverage gaps during every open enrollment period. Not whether coverage exists, whether what exists is sufficient for your actual circumstances. Those are not the same question. The fifth trap is the one that costs the most in purely tax terms, and it's made during a moment when most employees are focused on something else entirely. Not adjusting withholding after a compensation change. You get promoted. Salary increases. Maybe a bonus structure activates. You're focused on the new role, the new responsibilities, the new visibility. Your W-4 hasn't been updated since you started. And because the default withholding tables are blunt instruments that don't account for your complete financial picture, investment income, spouse income, deductions you're eligible for, you drift through the year either over withholding or under withholding, and you only discover the scale of the drift when you file. Over withholding is the more common trap, and the more insidious one because it feels like a windfall. The refund arrives and it feels like found money. It isn't. It's your money that the government held interest-free for 12 months while you could have been deploying it. The psychological reward of the refund, the lump sum, the relief, the sense of getting something back, is the mechanism by which millions of people voluntarily give up the time value of their own income every single year. A tax refund is not a bonus. It's evidence of miscalibration. And recalibrating your withholding after every compensation event, promotion, bonus activation, equity vesting, spouse income change, is basic financial hygiene that nobody in your organization will remind you to do, because it has no bearing on their cost structure whether you do it or not. The sixth trap is the one executives understand and entry-level employees almost never do, and it sits in a benefit category most people treat as an afterthought. Not using your deferred compensation or supplemental benefits before they expire or become inaccessible. Many organizations, particularly above a certain size and compensation threshold, offer benefits beyond the standard package, supplemental retirement vehicles, deferred compensation plans, tuition reimbursement, professional development stipends, wellness accounts, legal services, financial planning sessions. These benefits have one thing in common. They require proactive enrollment or activation, they have annual use it or lose it mechanics or contribution windows, and they are used at dramatically lower rates than they're budgeted for. The budgeting is the tell. Organizations forecast utilization of these supplemental benefits knowing that a significant percentage of eligible employees will not access them. The forecasted non-utilization is built into the cost model. The benefit exists on paper. The actual cost exposure is lower because the population it's offered to is predictably underinformed or too busy to engage with it. One company I'm familiar with offered an annual financial planning benefit, access to a fee-only financial advisor for 2 sessions per year, fully covered. Utilization in the first year it was offered was 11%. Not 11% of eligible employees were uninformed about complex financial matters requiring professional guidance. All of them were. 11% of them took the action required to access the help that was already paid for. Every benefit you're entitled to that you don't use is a wage reduction you administered yourself. The HR department isn't hiding these benefits, they're listed. But listed and accessible are not the same thing, and the friction between knowing something exists and actually claiming it is where an enormous amount of employee compensation quietly disappears. Here's where the frame has to shift, because understanding individual traps without understanding the architecture that produces them means you'll close some gaps and miss others that haven't appeared yet. These traps are not accidents. They're not oversights in system design. They are the predictable output of a compensation architecture built by organizations whose primary interest is cost management. Specifically, the management of total compensation costs in ways that minimize actual payout while maximizing perceived value during recruitment and retention. A benefits package is a product. It's designed with a specific economic logic, offer enough to be competitive, structure the delivery in ways that reduce realized cost, and rely on information asymmetry and behavioral inertia to do the rest. The information asymmetry is real. Most employees are not financial professionals. The behavioral inertia is real. Changing a default requires effort, and effort during high distraction periods like onboarding and open enrollment is a finite resource. The organization understands both of these things. That understanding is embedded in how the system is built. The employee who stops falling into these traps is not smarter than the ones who don't. They've simply stopped assuming that a system administered by their employer was designed with their financial optimization as its objective. Once you make that assumption correctly, once you treat your benefits package as a product to be evaluated rather than a gift to be received, the traps become visible. Not because they've changed, because you're finally looking at them accurately. Your compensation is not what HR communicates to you. It's what you actually capture from everything they offer. And the gap between those two numbers is a decision you make mostly during the first few weeks of employment, mostly under conditions that are almost perfectly designed to produce the wrong decision. Now you know where to look. Pull out your benefits summary this week. Not to review it, to audit it, specifically against everything covered here. Calculate what you're leaving on the table. The number will be uncomfortable. Good. Discomfort is information. Act on it before the next enrollment window closes. If this kind of analysis is what you're here for, subscribe.